The July, August, September quarter was a landmark quarter for market performances as well, because the Indian markets and the Chinese markets created a historic gap of outperformance. A $5 trillion wipeout of China and a really remarkable performance by India meant that MSCI India has beaten MSCI China by the most since 2000. In fact, MSCI India index rallied 10%, nearly 10%, and MSCI China index slumped 23%, as a result of which this 33% gap, it dates back to the kind of performance that happened between two countries way back in 2000. Now, the question that people are posing out here is that, is a China plus one factor applicable for equity markets as well? It happens in fundamental business case, because a lot of factories are moving out from China into various ASEAN countries, including India. But could it be happening in the equity markets? Well, multiple reasons. One, Indian valuations appears expensive to China, not because just that India has outperformed, but because China has remarkably underperformed, not just India, but the rest of the world as well. Two, Indian markets have given foreigners the comfort that they can sell at a comfortable tape. Look at the first 6 months of 2022, foreigners pulled out over 2 lakh crores, and the Indian markets corrected, yes, but did not buckle down. And there are some ex-China GEM funds, general emerging market funds, that have been established in 2022, which invests into all emerging markets ex-China. In those funds, India's weightage moves up, and that automatically means inflows into India. Mind you, there are not too many funds like these, but there are. But frankly, this is not just the current year's phenomenon. A Morningstar India versus Morningstar China index performance shows, and this is as of July, by the way, but this shows that across time frames, we've seen Indian markets, the Morningstar India index, outperform the Morningstar China index by a wide margin. And you can see in this chart, almost across time frames, we've had Indian markets outperform the Chinese markets. Now, we ask experts about why this could be the case and what's the outlook ahead. One response that we'd like to show out here is from Prashant Khemka of White Oak, who runs a GEM fund as well, and therefore it's also very pertinent. He says that if we think of India and China as two companies, it is easy to appreciate the difference in multiples. In any sector, a company with poor or deteriorating governance trades at a substantial discount to the one with better and stable governance. And from an investor's perspective, recent developments in China mean that India is preferred, and in stark contrast to what's happening in China. I guess that probably explains the extent of outperformance that India has had versus China in the quarter gone by.